Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. All right, let's move on to Disney. They just released earnings, revenue up 9%. Let me just share the basic numbers here. I won't skip around the presentation too much because there's a lot of words here. Revenue up 9%, income from continuing operations before taxes up 30% to $376 million. Earnings per share 30 cents, so down 19% from a year ago, and free cash flow down 10% to $1.4 billion. There are a lot of pieces to talk about with Disney, so I want to just go through a few of those. As I pull up the media and entertainment business, revenue is down 3%. I'll cover a little bit of that. The linear TV segment is on the decline. That shouldn't be a huge surprise to anybody, but I think it is pretty notable. Disney Parks, Experiences, and Products up 36%. So here's where you're seeing continued strength in the parks and physically going out and doing stuff. I think this is, to me, the theme of 2022 is the companies that are making experiences that people can go out and do. Las Vegas casinos, theme parks, airlines, hotels. Those are businesses that have done just shockingly well this year when you consider where we were at a year or 2 years ago. So I think
Bank of America and their earnings release at the beginning of earnings season a few weeks ago, they had a slide that showed like some spending trends, and by far the bucket of the areas that they showed with things like food and fuel and travel and entertainment was one. Not just the dollar amount, like the percentage of spend, but the number of transactions was in those experiential kind of things. So that's right in Disney's sweet spot right now, with that parks experiences business, because they're flexing pricing power right now too, right?
Absolutely. And then to go to the media and entertainment side of the business, segment operating income was down 91% from $947 million to $83 million. But here's the way to think about that. Linear TV is down, and they're trying to grab as many customers as they can in streaming. Because once you have scale in streaming, now you can start raising your prices and increasing margins. What did Disney announce just a few weeks ago? They're increasing their prices to $11 a month for the basic plan without ads, and then there will be an ad tier for $8 a month. So this streaming service that was a steal at what was it, $5 a month when it launched just before the pandemic, is now going to be more than twice that price. I think this is the part that has been sort of difficult to watch as an investor, because the playbook is pretty simple. We're gonna grow this user base as much as we can, and then we're gonna slowly ratchet up prices over time. But you're gonna lose money in the process, or you're gonna not make as much money as you were making in the past in the process. So investors are gonna have to be patient with that. This seems to be playing out, but it's still gonna take more time, and we may not see that margin hit until a year, 2 years from now. And we've seen companies like Netflix and Peacock, companies like that are having trouble adding customers at the rate that they once expected. At least they have in the last couple of quarters, and some of them don't have pricing power at all. Disney, I think, has both, so that's a good spot to be in.
Yeah, Travis, I think one of the things about Disney, to me, that's when you compare it to, say, Netflix and even Amazon to some degree, and some of those platforms that, like, for example, Amazon and Netflix started as streaming, right? Well, Netflix didn't start, but you know what I mean. Like as it exists today, it's a pure play streamer. The Amazon has acquired some original content, right? It's bought a pretty big library, and it's investing in original content. And Netflix has invested a ton in original content. Disney is the one legacy content owner that's going through this transition where the bulk of its of its operating income in that segment, like you said, was coming from linear TV, and now it's building the platforms, those over the top platforms. And the sports one is going to take long time. I think we should mention ESPN.
Really long time. Yeah. Yep.
Because it's going to take a long time. And to a certain extent, like with that, it's going through this zero sum period where it still has a lot of contracts and it gets a lot of its cash flow from cable providers, right? It's slowly trying to detach away from that. So there's going to be this zero sum period, even with ESPN, until those contracts start to expire and it can start scaling up the ESPN streaming products outside of people using their cable access, their login for their cable company to access, ESPN and actually get like the NFL and Major League Baseball and those sorts of things. So I think that's an important thing to remember about it, is it's not just a land grab for Disney Plus and a land grab for Hulu. It is. It absolutely is, right? But it's also this transition for ESPN. What I really wanted to say about it, Travis, is just like with the theme parks business, Disney has just the amount of intellectual property that's relatively timeless that it has is a massive differentiator. People talk about Netflix having great IP. When's the last time anybody talked about Orange is the New Black? Right.
Or bought an Orange is the New Black toy, or went to a theme park that had.
That's the thing. You think about the Pixar, those toys, right? Cars, those things are timeless, and they're going to get rebooted over time. You think about the Marvel stuff, right? Same thing. Yep. These are relatively timeless. And the reality is that for so many of the things that are being developed by these other streaming partners, is they're interesting and they become like, they have their pop culture moments, but they're not particularly timeless in the way that so much of Disney's IP is. And that's a massive differentiator, and why I can't imagine ever not owning Disney.
I 100% agree. And I think that is, from a content perspective, the thing that investors really need to think about is how would you depreciate a piece of content that Netflix is buying or creating, and how would you depreciate a piece of content that Disney is buying or creating? Because I think those two things are very different. Like you said, Disney is very good at monetizing what they have. They still are going to movie theaters, and then they have Disney Plus, and they've got linear TV. But the content that they're making is going to be something that, my kids are 2 and 5. They're watching the same movies over and over and over. They're watching the movies that came out when I was relatively young, when the first Toy Story came out. So that's really the difference here is this model works. I do want to pull up, because I think this shows exactly what we were talking about. Linear networks down 5%. So revenue is down 5%. But look at this, just printing money, $1.7 billion in operating income. So from a cash flow perspective, that business is still doing really well. Direct to consumer, which includes streaming, growing only 8%, so not growing as much as it was over the last few months, but it's losing $1.5 billion. Now, just do some back of the napkin math, and the price increase that they're implementing over the next couple of months, they'll get closer to operating income break even just with that price increase. So I think that's a good position for them to be in. They may have to pull back some of that spending on streaming because they can't burn money there forever. But this is the kind of company that I want to be in for the next 20 years, not for the next 2 years. So I don't particularly care, if they're losing $1 billion or 1.5. I just want to see that the momentum is going in the right direction. And I don't see another company that's better positioned in streaming today than Disney.
Yeah, it blows my mind a little bit. The Disney stock right now is cheaper than it was 3 years ago, right? Yeah. The other thing too is that, yeah, sure, if we do go into recession, and if it's as bad as it could be, that's going to be terrible for the theme parks business, right? It almost certainly is. But it's the kind of thing that can actually be a boost for all of its efforts for streaming, because they're low cost, and people are always looking for something to. They're looking for a way to kind of get away from their troubles, right? And so, yeah, it's interesting.
All right, final thoughts on Disney. I'll start with this. We're in a market where investors are oftentimes, I think, well, we had a conversation about Upstart, right? They're burning cash. We need to ask questions about how long can you do that? We talked about Lyft yesterday. Same question. How long can they keep burning cash? Disney, it looks like the market's pretty disappointed by this result. The stock's down a little over 6% after hours, but they're still profitable. They're still generating free cash flow. They're still, I think, one of the best names in streaming. They're arguably the best name in media. If the stock drops, I think this is a great buying opportunity. Just set it and forget it.
I have nothing to add.
Thank you.